Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named the best online brokerage in Canada by the Globe and Mail for the third straight year and counting. I'm your host, Rob Moise, and you're in for a treat today because this episode is all about laughing and learning. Because face it, you're going to make investing mistakes no matter how hard you try. That's just the reality of it. But the important thing is to take those stumbles in stride, learn from them, and make light of them. To quote my favorite 1960s era humor columnist, Irma Bombeck, who I totally just Googled before this episode, if you can laugh at it, you can live with it. So on that cheery note, we're going to reflect on some of the funniest mistakes that DIY investors have made and the lessons that others can take from them. And here to share some of their stories that they've heard, and perhaps some of their own, of course, are Joel Larsgaard and Matt Altmix, co-hosts of the How to Money podcast. Joel and Matt, great to have you guys here with us. Thanks for taking the time.
Hey, thanks for having us. We're glad to be here.
Y'all. Yeah.
You guys have a really fun podcast. I encourage people to check it out. It covers all things personal finance, investing, and you guys have a rapport that is just like truly awesome. Really, really sucks you in as a viewer. So I just want to start, simply just to get to know a little bit more about you guys. What made you guys want to start this podcast in the first place?
Oh, so, we just like money. We like talking about money. And Joel and I, early on, we had conversations as best buds. We met in our neighborhood. Our wives hit it off as well. And anytime we got together, we would talk about investing. Actually, at that point in time, we were talking a lot about real estate. And we'd always enjoy a craft beer. And so finally, Joel was looking for something new to do. I was looking for a new sort of gig. And we said, why not start a podcast? Let's take it seriously. And How to Money is the results of that.
Yeah, let's do the thing that we do when we get together anyway. But let's record it and see what happens.
Yeah, I know. I have friends that I talk money with all the time here too, often over beers. And I find when the couples get together, the wives are sometimes like, yeah, okay, you guys do your thing, drink your beer, talk your money, whatever like that. We're going to talk about other stuff that we find more interesting.
That's exactly right.
One thing I'll say though that's like truly awesome about you guys' podcast is that you guys are quickly approaching the 1,000 episode mark. If I'm correct here, that is a phenomenal run, like for any kind of podcast or program writ large. So, what's the secret to keeping listeners hooked in your mind?
Oh man, I think it is. I think for what Matt and I do, it is just an approachability to a subject that most people find obtuse. And I think a lot, like the way most people talk about money, there's so much jargon and there's so much like talking down where we're just having a conversation that we're letting the listener in on that I think just it disincorporates all the stuff that typically makes finance too tough to stomach for most people. And so the simpler we can make it without making it stupid, like it's not, you can have just be a normal person and learn about money. And I think that non-stodgy approach is what keeps people tuned in.
Yeah, I think it's one of those things that people get intimidated by right away, but it's something that touches everybody's lives, right? So, we should be talking about it, whether you want to do it in an informal setting or a more formal setting, what have you, but you need to be talking. I think enough people don't necessarily talk about it all the time.
Agreed. Yeah, man. And the fact that we enjoy it, right? And so I think folks can, why do listeners keep coming back to How to Money? I think it's because we enjoy it. We are genuinely interested in personal finances and how we can make that something that others can learn from to achieve the goals that they've got before them in their lives. So, when you're faking it, I think folks can tell. And so I think that's why folks are sticking with us.
So do you guys have like a big 1,000th episode, like special planned or anything like that? Can you give us a peek behind the curtain, perhaps? Anything like that?
We've talked about needing to do something, but to be honst, we haven't. Yeah.
The goal is to get Warren Buffett on with us. I just don't know if that's going to be feasible or not, but we're trying to pull the levers that we can pull.
Hey, 1,000 is a pretty big milestone, so maybe you'll pique his interest. I don't know. Let's see. Yeah. Fingers crossed for you guys. Now, obviously, you guys have heard from all sorts of listeners over the years. That's a big part of your show, taking questions from viewers as well and listeners. So what would you say are some of the most common hangups that you find that people are constantly running into, specifically about like DIY investing, that ends up holding them back? Do you guys find you have to constantly help people understand?
For me, I think a lot of it has to come down to folks trying to find the balance between living the life that they want today in the here and now, as opposed to the kind of life that they want to live off in the future, right? Because that's what investing is, that deferred spending. And The problem, though, is we don't know what the future is going to hold. We don't know what kind of health we're going to be in. We don't know what kind of interests we're going to have. We don't know what kind of goals that we're going to have for ourselves way off then. And so you run the risk of over-investing, which is, there are fewer folks who run into that problem, obviously. And they're not living in the here and now. But then the vast majority of folks, certainly our listeners, are folks who, man, they want to invest more than they currently are. And so it's trying to find, like, how can I pare back? How can I get more money invested into the market? So striking that balance is, man, that's challenging. That's a part of why. So on the show, you know, we enjoy craft beers, and a part of why we do that is because it's a way to physically show that we are enjoying life in the here and now. These are expensive beers, by the way. Like, we'll buy a bottle that we'll share that's like $25, $30. It's not, we're not drinking macro produced American Pilsners or whatever. So you do the thing now, but we're also being smart about the future as well. But I think for a lot of folks, finding that balance for them can be what's tricky.
Yeah, I think too, there's just this something that's gotten a brain block for so many people. And I think Wall Street created it in many ways, where it's like, oh, you want to be an investor? You need sophisticated knowledge and the help of someone wearing a $3,000 suit to get going. And the truth is, investing has become so democratized that that's not accurate, right? And so, but people still, that belief still remains, and I think it limits people from thinking they can get started. And so that's at least part of our mission, is to help people realize there is no like secret that you have to uncover in order to actually get going. You can get started on your own without the help of someone who gets paid a lot of money.
Yeah, and that's one of the messages that we have here at TD Direct Investing as well. Like, you can invest for yourself with a little bit of education and stuff like that, which is what we try to provide here too. And on that note, for those folks in the audience here, if you're joining us and you have a question about investing, make sure you submit it here. We have a question and answer box here, and later on in the program, we're going to be taking questions for Matt and Joel, so you can pick their brain and see what they think about topics that might be on your mind here. If you're joining us on our YouTube live stream, by the way, you can also get in on the conversation here. There's a link to this broadcast platform that we're using here in the description of the event. So just hop in there, quickly register, and you can get your questions in there. You can also vote on some of the polls that we have coming up here too. We got a trivia question. I'll tease a trivia question for us here later on. So make sure you get involved with that. Anyway, I have a little bit of a lightning round that I wanted to kind of throw at you guys here, if you guys are cool with that. The idea here is that I'm going to ask you a few short questions, and you're going to share your take in as few words as possible. And just for simplicity's sake here, let's start with Matt, and then we'll have Joel answer on the back half here. So how does that sound? You guys ready to go?
So ready.
Let's do it.
All right. Well, so we were talking about how you guys like to drink beer on the podcast. What's your favorite brew when you're talking dollars and cents?
Oh, for me, all right, lightning round. Anything aged in a barrel or on oak? So the oakier, the better.
I'm going to say hazy IPA.
Right on. And if you were to describe your own financial situations as a beer, which would it be and why?
Okay, so going back to the barrel aged, my financial situation would be a barrel aged beer at the peak of its optimal drinkability. Because if you wait too long, what happens? That beer starts to degrade a little bit. But if you hit it too soon, maybe it's not at its full potential. And I feel like I'm entering into a stage of my life where I'm thinking through, what does it look like to prioritize the things that are important to me, to not defer living life until I'm, sitting on the front porch, fully retired. I'll stop. Lightning round.
I'm going to say mine is a hoppy Pilsner, because it's got some flavor to it, but it's also light. And like, I don't want to overdo it and put too much thought into my finances either. Part of my goal of being good with money is to not have it dominate my life or my thoughts. And so, yeah, I'm gonna go hoppy Pilsner.
I think I'm a little bit of your mind there, Joel, as well. Like, I try to keep things simple in my own life here too. Okay, next question. On a scale from 1 to 10, how well would you say that your co-host knows how to money?
Oh, I'm going to give Joel a 9 out of 10.
Okay.
Because there's always something to learn.
That's true. There is always something to learn. If I gave Matt a 2 out of 10, that might ruin the podcast before we get to episode 1,000. I think so. Truly, we've been doing this for so long. I think Matt probably knows even a little bit more than me. I'm going to go 9.2 for Matt. 9.2.
Oh, shucks. Also not true.
So that's how you can tell the friendship is real here, right? That's the bond of almost 1,000 episodes right here. You guys are so nice to each other here. Okay, finish this sentence for me. when I invest, never would I ever blank.
Pay more in fees than I need to.
Invest in something that I couldn't explain to my 9-year-old daughter.
Yeah.
Both phenomenal answers, words of wisdom. I totally agree with both. And last one here. If you could go back in time and give your younger self some investing advice, what would it be?
Buy 20 or 30 Bitcoin. Back in 2010, 2011. Yeah. Just 20 or 30, no big deal. Just
or ridiculous amounts of NVIDIA, right? Like if I knew what I know now, then or I would have just bought probably more rental properties back in 2009 through 2011.
Sure. Hindsight's 2020.
Yeah.
So.
For sure. I find that the thing with hindsight is always, even if you knew what to do, would you have the money to do it? That's the question, right? But,
see, that's the thing with Bitcoin's only like 9 cents a Bitcoin. I'm like, yeah, I could have done that.
That's true. That's true.
All right, guys, great stuff. Really appreciate you guys playing along. Let's get to the heart of our conversation, though, and that's the funniest investing mistakes and some of the lessons that you've learned from them. And this first one is sort of a tripping over the starting line type kind of mistake here, but a very common one, surprisingly, and that's in the United States, I would be opening a Roth IRA, which is in Canada here the equivalent of a tax-free savings account, and you stick money in it, but you don't actually invest that money. You think you're done after you put the money in. Real unforced error here. How could somebody make this sort of mistake?
We've heard from so many listeners where they hear a certain amount of what we say, or maybe they're brand new to the podcast and they're like, I opened that account way back when. I think I've got some money in there. And then they go back and they take a look and they're like, don't, it's stuck in a money market fund. Like, or the money was on the sidelines this whole time. And so I just think that is human nature in some regards, to not finish the drill, to maybe not go all the way, or to just feel a little nervous about, I did part of it at least, but God, I don't know if I want to actually become an investor, or there's almost like something subconscious that blocks people from doing that, I think, sometimes. So yeah, opening the account is crucial, and the tax advantaged account that makes the most sense for your situation, but then getting that money from the money market into the investment of your choice is a massive hurdle to overcome too. It's really not that difficult in actuality, but you've actually got to do the thing so that your money can be growing for your future.
Yeah, I like what you said about not finishing the drill. It makes me think about if you're like, all right, I've heard that grilled ribeyes are delicious, so I'm going to go to the store, I'm going to buy that steak, I'm going to bring it home, set it on the counter, and you're just like, all right, we're enjoying some ribeyes right now, aren't we? And it's like, no,
not quite. Not
it's
yet.
Sitting there in the package, and there's some other things you need to do. You got to pull it out, season it, salt and pepper it, grill it, right? Like apply some heat to the thing. And then finally, it becomes something more than what you showed up with, right? Like it's evolved into something that's even more delicious. That's what it looks like to enjoy a ribeye. And it's just maybe a misunderstanding of what it looks like to invest. It's like, oh, I've heard that you're supposed to get steaks. It's like if you're talking to an alien or somebody that doesn't understand the world that we live in, but it's just like, oh, I see, we actually have to cook the thing. I think that's what it means to invest.
Yeah,
I love the analogy, particularly around lunchtime here. I'm gonna go get myself a ribeye for lunch. That'll be good.
There you go.
I think for the uninitiated, they might say, okay, yeah, I've heard investing is good, but hey, at least I'm putting money in the account, right? Like I'm saving it. There's something there. It's not such a big deal, right? If I save it rather than invest it. What are they missing there? What's the opportunity cost that they're missing out here by saving rather than investing?
Well, it's fine initially, right? You do that for 1 year. Like what kind of returns are we likely to see in the total stock market or the S&P? But over time, the compounding year after year of making that mistake, that's really when it's gonna come back to bite you, because your savings rate early on, this is something that I don't know, I think maybe early investors get wrong as well. They think that all right, I'm investing, and they're expecting I've heard about compounding, but that compounding takes time. Initially, your ability to sock money away, that has a much bigger impact on how much you're able to actually save and invest, your savings rate, as opposed to whatever the return is going to be in that specific investment.
Yeah, if you were looking at a chart over 20 or 30 years of sticking money in a savings account, let's say even with a 3.5-4% return, which is about what people can get these days, versus average annual returns of invested in a total stock market index fund, that gap looks really small early on. And those first couple of years, you're like, I'm not really missing out on that much. But every extra dollar that you're gaining by investing instead of saving will that's just going to add more fuel to the fire to grow that portfolio amount. So yeah, by the time you look back 20 years later, and I've been an investor now literally for 20 years, started at 21 and 41. So when I look back, those early years, man, it felt like I was making no progress. And I'm like, I hear all these people talk about how incredible investing is. I've been investing for 2 years now, and all I'm seeing for the most part is just my own dollars that I'm sticking in. But 20 years later, now my money works harder for me than I can work to earn money. And that's like an incredible place to get to. It just takes a lot of time to actually like see that reality and live in it.
Yeah, I think one of the most powerful ways that like I try to think about this and explain it to others is, if you take a savings account, and let's say you're earning something like 1-2% or something like that, you literally, the money's just sitting in like a checking account or a high yield savings account or something like that. The impact of inflation over time, those 20-30 years, you're going to be losing money. And I think that kind of helps people make it feel a little bit more real, and it gives a little bit more urgency to it, because nobody wants to lose money, right?
I think it's a really important point, and one that we have to talk about again and again, because if savings accounts, it seems like the safe haven, like the smart, safe play. And I think that's why a lot of people gravitate towards that instead of investing. But when you help people understand the reality of inflation, how it's eroding savings, and think about, especially for all those years where 0.5% was about the most you could hope to get on a savings account, and inflation, it was lower, but it's still 2%. Every year, your savings are losing money. It doesn't mean you don't need a little bit of liquid savings. You do. But if you're prioritizing savings over investing to such an extent that you're not thinking about your future, that inflation is your worst enemy. And when you think of that as a known quantity, which it certainly is these days, right? We're viscerally feeling the effects of inflation. When you realize that, how that's impacting your savings, you realize that you have to become an investor if you want to like sustainably grow your wealth over time.
Yeah, a lot of folks, I think they tend to try to avoid risk by staying out of the market, but it's like, oh, you've got the potential for that risk to come rolling along, and you might see some down months or even years. But inflation is the inevitable known risk that is just going to slowly erode your savings over time were you to not invest.
Mm-hmm. Yeah, well said. Let's move on to our second funny mistake here. We got a lot to get through here. And this one is kind of assuming that you need to have a lot of money to start investing. Again, this is something that newbies, the uninitiated, very much think. And it's a misconception that is persistent, despite the fact that, what's funny here is it's easier to invest than ever before, really. Why do you think that this misconception is so persistent?
I think a lot of it has to do with just identity. And this is a conversation we were actually having yesterday, but just when you do something, you tend to identify with that behavior. And especially for new investors, when you haven't done it yet, it just feels like something that's just kind of beyond what it is that you're capable of doing. And so because of that, you're like, well, I don't know. I'm not really an investor. That's not my history. Maybe you grew up in a family and money wasn't talked about. Maybe investing wasn't something that you've heard of. Maybe the only thing about when it comes to investing, you're like, well, I watched Wolf of Wall Street, and it seems like that Jordan guy had a lot of money, and because of that, it seems like something that's maybe even beyond the reach of what it means to be like a real investor. But you know what? You invest $20 in the market, you are now an investor. And we try to encourage folks to do something like that, whether we're talking about business formation of like, no, you are now, you've started a business. Like you are an entrepreneur now. Same thing when it comes to investing. Get some of that money into the market. You are an investor. You don't have to have thousands and thousands of dollars set aside to be able to consider yourself an investor.
Everybody's heard the phrase, it takes money to make money. And so I think that becomes internalized too. People are like, well, I don't have much money, so how am I going to make it? And man, my first job, I was not making bank. Like my salary was pretty pathetic. And for most people, like their first job out of school, like they're not bankrolling big money. But there's something about identifying yourself as an investor, sticking at least a few dollars into the 401k or to whatever that tax advantaged account equivalent is for you, opening up your own individual investment account, putting a little bit of money in. And it's easier now to do than ever before, right? It used to be really difficult. It's so easy, in fact, that during COVID, we saw people essentially like gambling on the stock market because it's just so simple now to stick a few bucks in there and buy some stocks and get crazy. That's actually a downside we have to fight against these days, I feel like, with our listeners, trying to convince them to take the low, slow, steady approach. But yeah, just because you've heard that it takes money to make money doesn't mean it's true. It takes small amounts over a long period of time, and you'll be shocked at how much wealth you're able to build. It's just not one of those things that's going to happen overnight. And I think sometimes the kind of get rich quick mentality is where people's heads are at, and it feels easier maybe to play the lottery than it does to invest that $20.
Mm-hmm. And especially now with things like partial shares, which is something that we at TD Direct Investing have amongst other brokers, is that you don't even need to afford a full share of, let's say it's an expensive stock. You can buy just a slice of it, and over time, like compounding more and more over time, it makes it so much more easy to do it than before.
100%. Yeah.
Now, we did hear a movie reference here, so I'm gonna send it back to you guys. Favorite investing movie and why?
Oh my gosh! Do you watch investing movies, Joel?
I'm trying to think if I have a good investing movie.
Okay. I'll jump in and say that this isn't necessarily an investing movie, but Moneyball, taking a more analytical approach. I don't know, just getting smart about how you make decisions as opposed to going with the prevailing narrative as to what it is that you should do. I love people that are just challenging the narrative. They're thinking differently. They're looking at results as opposed to saying, well, this is what you're supposed to do. Let's just do that in a similar way. Oh, this is what it looks like to be an investor. I guess it's got to be like that. Well, no, there are different ways of doing it. And just given the speed of technology today, I don't know. We live in a more dynamic, ever-changing landscape than ever. And so I think being more attuned to the fact that we can do things differently than not even like our parents, but even just like a few classes ahead of us, like if you're in school and you're thinking, all right, I knew some guys and they got that first job and this is how they're doing it. I think there's a chance it could look a lot different even for those folks too.
All right. It's not an investing movie. I'm going way back to like my elementary school era. Remember the Disney movie Blank Check? And the kid, he just he essentially had a checkbook that was blank, and he starts like buying all the stuff to live his dream life. And it turns out that buying tons of stuff doesn't lead to an actual dream life. So maybe an anti-consumerism movie at its heart, which I can resonate with.
Also, you shouldn't forge checks too.
Right? Yeah. Don't do that either.
Nice disclaimer to throw in there. Yeah, both good movie picks. I think I'm going Charlie Sheen and Wall Street. I think that's my
classic.
Pick. Good movie.
Hard to beat.
Okay, so we talked about how you don't need a lot of money to start investing, but in your opinion, like how much money would somebody need to start investing? And perhaps just as important, is there a right time for them to start investing?
I mean, early and often, as far as timing goes.
I think it's the tree scenario, right? It's like the best time to plant a tree was 20 years ago. Second best time is right now.
Yeah, and so I think for a lot of folks, and this personally. We always talk about dollar cost averaging, not paying attention to what's going on. Not, you're saying, I'm focusing on the win part of your question, Rob. But there's a lot of debate, I think, over whether or not folks should just go ahead and just do the solid dollar cost averaging. But when you look at the data, the fact that 3 out of 4 years the stock market does go up, if you have the capacity to kind of get ahead of that wave a little bit. So let's say you hit your limits for your retirement accounts this year, start saving for next year, because that way when the new year rolls around, the ability to pull that trigger, at least in the US, waiting for that window to open and getting that year's allotment. I'm pretty sure in Canada you'll have the ability to roll that forward. But even still, man, the sooner the better in my book.
Yeah, I agree. Sooner the better. And I think one tale of caution is when should you start investing? Well, only after you've amassed an emergency fund. Because I think one thing people do, they maybe hear about investing and they're like, sweet, I'm gonna start growing that wealth. Let me get after this. I think it's a great thing. And I don't want to steer anybody astray and tell you not to do that, but make sure that you've achieved those baseline financial goals first. And one of the main ones is to accrue at least a small emergency funds. It doesn't need to be 6 months of expenses quite yet before you start investing, but you do need a baseline emergency fund of around $3,000. Matt and I think we calculated today $3,047 is what the average person should have to be able to at least help defray the cost of any potential emergency that might come along. So if you have that much saved, then you can start thinking about becoming an investor. But if you haven't started saving at all yet, or if you've got really high interest debt, that might be something that you're looking forward to doing, but you're not quite there yet, if that makes sense.
I think the point about debt is a really good question. And I'd love to ask a follow-up about that because, oftentimes, especially like younger investors, they want to invest for the future, but and they might have student loans, they might have like a car loan or maybe a mortgage or something like that. Do you think there's some kind of rule of thumb on whether you should be paying down debt versus investing? Anything that you guys like to fall back on?
I mean, typically, so it completely depends on the type of debt. It depends, and in particular, the rate of interest that you're paying. Because so for instance, some folks hate home debt. They hate mortgages. Guess what? That's not us, especially if you lock that thing in at 30 years, several years ago, and you're looking at 3% or less. I mean, that's the best debt. As good debt goes, I'm hanging on to that as long as I possibly can. So that's an example of some debt that you might have that you don't want to pay off early. Same thing with student loans. If you happen to have a rate that's lower than 6-7%, I'm not going to be in a massive rush. Anything above that, okay, you are unlikely to see any kind of return from the market. That's guaranteed, right? Like that, and that's the other part of it. The fact that you are getting a guaranteed return on your money by eliminating something that's 7-8+%. I'm definitely going to be pointing folks in that direction.
If we're talking about credit card debt, paying off credit card debt beats investing 99% of the time. And the 1% of the time that it doesn't is if there's some sort of match on your investing dollars, right? So if you're contributing to a workplace account and they're matching dollars and they're matching 50 or 100 cents on the dollar, whatever you're contributing, then you get that match and then you pay off credit card debt. And then once you pay off the credit card debt, then you go back to investing more into that workplace account, right? But you don't want to miss out on free matching dollars, even though credit card debt is heinous, especially in today's environment, interest rate environment where interest rates have been soaring.
Yeah, I mean, grab the free money if it's there, right? I mean, that makes perfect sense. We talked a bit earlier about like crypto and stuff like that, and I think that's something that's very top of mind for a lot of investors. Maybe even folks who haven't started formally investing in your stocks, your bonds, that kind of thing, but they hear about crypto. It's in their face all the time, or other sort of alternative investments. And so the third funny mistake we're going to talk about here is opting for the quote unquote sexy investments over the more traditional, tried and true, boring stuff. This is a really interesting one. And before we kind of dig into it, let's just kind of get a lay of the land here. Who's hot, who's not when it comes to investing products in your mind? What do you consider like a sexy investment versus a boring one?
Gosh, I feel like the alternative investment space has grown so much over the past 10 years. And in particular, the direct-to-consumer alternative investing space. And so there are websites now where you can invest in wine, you can invest in whiskey, you can invest in artwork, you can invest in farmland. And so there are, you can invest directly in different real estate projects. And that's kind of cool, right? At least from like an attention grabbing perspective. As someone who wants to invest for their future, you're like, man, there have never been easier ways to invest in these really semi-exotic products. And yet I think for the most part, those investing in those avenues would lead you astray. And it's just not necessary. And most people what they don't see is that some of those assets are highly illiquid, that they come with significantly high fees, that there might be better ways. Like for instance, in when we're talking about investing in some of those newer alternative investment real estate sites or funds, well, maybe investing in a publicly traded real estate investment trust would be a lower cost, easier, more liquid way to do it. So I guess I've seen so much more press about those alternative investment sites. We've had so many more questions from listeners like, oh, do I need exposure to this? Do I need exposure to that? And I think for the most part, the answer is no. And if you're crushing it on the boring stuff, which we think boring is actually the best when it comes to investing, then maybe you can think about some of that stuff. Just know the trade-offs.
And just to clarify for us, like what would you consider like a boring investment?
Oh, the stock market. I mean, traditional equities, right? The total stock market, the S&P 500, within a tax-advantaged retirement account. I mean, that's the bread and butter. It's like, it makes me think of like diets or working out. Like there's always like these different fads, and it just depends on who's got the edge on marketing or what the latest so-and-so is doing that's in this, the celebrity spotlight. And, oh, okay, they're doing this. Like, so more attention starts being drawn that way. So it just varies. It just depends on tastes, just the different things that people think that are cool. But I mean, I think, and maybe you're alluding to crypto as well. It's funny because I feel like even crypto right now has kind of fallen out of favor given FTX, given the downfall of just some of the players who were doing illegal stuff.
Those meme coin attempts that fell flat.
All of that. But at the same time, I still think, generally speaking, crypto is a sexier investment than a lot of traditional securities because of the fact that it's digital. It's the new frontier. Like, what's it going to look like? Who knows? But more and more, in particular, younger folks, I mean, we're digital natives, right? Like, we have grown up always being online, on the internet. It's a very real thing. And because of that, there's a level of comfort that comes with investing in crypto that I think older generations don't have. And so because of that, I honestly think we will continue to see more and more folks kind of drawn into the crypto space when in reality, they probably need to be doing some of the basics, right? Yeah. Going back to the working out. They probably still need to be going for a light jog. Like, there's some things that we have known that are always going to be good for us. Like the easy run and lifting weights. That's the S&P 500 and the total stock market.
Yeah, and our typical rule of thumb is to say, if you want to invest in some of those sexier alternative spaces that might come with higher fees or more risk in the if we're talking about cryptocurrency and Bitcoin, limit it to 5% of your overall portfolio. Like, just make the big sandbox, kind of the basic boring stuff, traditional overall market investments. And then, especially if you're in the wealth building phase of your life, and then if you're super excited about kind of paying attention and messing around with your portfolio and buying individual stocks or cryptocurrency, just make sure you have you have limited exposure. That's going to help you sleep at night, and it's going to help your main thing just grow wealth, because we just have a lot more history and data about the stock market. We have basically 120 plus years now of stock market data, and we just don't have nearly as much with cryptocurrency. There are much wilder swings. And I think for me too, again, kind of going back to how I think about money, well, I just don't want to be thinking about it all the time. And I think for some people, if they get into that, I'm investing a lot in individual stocks and I'm buying up more cryptocurrency and I've got this huge portfolio of stuff to manage, it could be triggering taxes that you didn't really think through, maybe if you're buying and selling randomly. And two, you're just thinking about your investments a whole lot more than you need to.
Yeah, one of the best analogies I've heard from a colleague at TD here, it was that, investing is like a bar of soap. The more you touch it, the more it's going to dwindle away, right? All those trading fees and commissions and all that kind of stuff. Just talking about crypto, I can understand people thinking, blue sky about some of these speculative investments, but the one thing I'll never understand is if you invest in some weird meme coin called like Poo-Poo Coin or something like that, how did you think it was going to end in anything other than a rug pull? That I will never understand.
I agree with you. I think if you are investing in some of the more mainstream cryptocurrencies, Ethereum or Bitcoin, and you lost all your money, you would be surprised at this point because there is enough of a history. But if you're investing in those meme coins, even if they are launched by heads of state, be very careful. I wouldn't touch it with a 10-foot pole.
Yeah. I've heard it referred to just as it's like almost like a baseball card or something like that. It's like, okay, you got this thing that shows that you're a fan of something. Like, okay, that's fine. It's a way to show support. But anything beyond that, if you expect it to be anything like an actual investment, it's like a Beanie Baby, right? It's like, okay, I'm not expecting to take this Beanie Baby to the bank or
it's
anything.
Like a personal blow, Matt. Okay, I have a big Beanie Baby collection, right? So
Joel's looking forward to the untouched Beanie Baby collection in the attic.
They're going to resurrect in value. Okay, I promise.
But I think that could be a helpful way to think about some of those coins, and certainly to the NFTs as well.
Listen, I hope for your sake that the Beanie Babies do something here, only because it takes a lot of willpower as a child to not open the toy packaging and play with the toy.
I know. I passed the marshmallow test. I held on to those for a long time.
So regardless whether we're talking about crypto or other alternative investments in general, just kind of lay it out for us. Why can these more complex, sexy investments, if you will, why can they potentially backfire on an investor? Why do you guys keep going back to the tried and true stuff?
Man, I was even looking on one of these alternative investment websites, specifically for one where you can buy farmland. And when you look at the numbers, farmland has actually been a really good investment over the last 50 plus years or something like that. But even on their website, when they're talking about just how good of an investment farmland is, the S&P 500 has provided greater returns than farmland has. And it says so on the website, given their data. And on top of that, the S&P 500 just takes a lot less of my attention. And it also comes with significantly lower fees. So if I want to invest in farmland, yeah, it's been a great investment, but you just have to have a little more knowledge. You have to have more willingness to understand the details of what you're getting into, and you're going to pay much higher fees in order to do that. So go do it if you want, and with a portion of your investment portfolio. But I just think for most people, it's the set it and forget it. That's the other thing too, is with investing in the market, many people are doing that through their paychecks regularly. And so there's that dollar cost averaging aspect that's so helpful. And there's also the aspect of it kind of coming out without you. I mean, you know what's happening, but you're also not like seeing it and actively having to shove that money into the account if you're investing in a workplace retirement account. And I think there's such a benefit to that, because if I have to actively go over and stick money into something, I'm just less likely to do it than if I kind of set it up when I first started the job. And the money is like automatically flowing out into those investments too. So I think there's a few reasons why the tried and true boring method is better than the sexy one. The sexy one, oftentimes, we're just less likely to actually pull it off and make it happen.
Yeah, I think that's an interesting point. And another little chart that I dug up doing some research here that I found really interesting was it was looking at when an ETF provider launches some new fund based on whatever the trend du jour is, whatever it may be. You were actually, by the time they get it to market and you're all excited to invest in it, you actually more often than not missed the peak of the hype, and then from there it's kind of more mediocre performance or something like that. So it's hard to cash in on some of these sexy investments, even if it seems like it's really front and center here.
I mean, the perfect example of that, by the way, is the ARK, Kathy Wood's investment ETF. Came with like a 0.75% fee alongside of it. And when did most investors stick their money in? Within months of the top, right? And so that's when people start to hear about the thing, is after it's already seen a big run up. And then you're like, finally, your curiosity has peaked to the point where you're like, let me stick some money in. And sorry, you were the sucker who came too late to the party.
Well, so speaking of how people get their information about investing and how they hear about things, I want to take a little bit of a pause in the action here. I have a trivia question. I had teased it earlier here for our audience, and you guys feel free to play along here too. If you're joining us on our broadcast platform, you'll be able to vote in the screen there. And if you're joining us on our YouTube live stream, again, just follow that link in the description. You can hop into the platform here. You can cast your vote and also ask your question for Matt and Joel as well. Without further ado, here's the question. What is the top source of information for Canadian DIY investors when making an investment decision, according to a survey by investor advocacy Fair Canada that was done back in 2022? So we have a few options here. Social media and podcasts being choice A, choice B, friends and family members, C, company financial statements, or D, print or online media stories. So cast your votes now. We're going to reveal the answer in just a moment. But Matt and Joel, I'm curious, do you guys care to venture a guess here? What's the right answer?
Well, I don't think it's fair that you lump social media and podcasts together. They're very different forms of media.
Oh, that's true. Yeah, you got all the influencers out there. And, well, I don't know, because they're effective. Like, sometimes not in a good way, but unfortunately, I think there's a lot of folks who are listening to folks there. I would say friends or family members, because of the fact that, I don't know, I think back to some of my, I don't know if I'd call it failed investing early on, but actually I guess I would. And I listened to a friend, so I don't know, I think friends and family still has a pretty big impact on how it is that folks invest.
I would guess. What do you think? I think social media these days, it seems like the place where a lot of people are turning. There are so many people trying to offer you advice for how to invest. Many of them are great, and then many of them don't know what they're talking about or are trying to actively steer you towards poor investment choices. And people just spend so much time on social media these days. So I guess that'd be my guess. Okay,
so honesty time for both of you. Have you guys ever taken an investment? Matt, we heard that you had taken an investment tip from friends and family there. So Joel, have you done the same? And then for you, Matt, have you taken a tip from social media influencers or anything like that?
Maybe not a tip from somebody, but I did invest in a friend's company at one point. And I went into it with eyes wide open. And again, going back to that 5% rule, it was a small sliver of my net worth, and I felt comfortable doing it. And so it was less a tip and more like, hey, I think I like what you're doing and I like where you're going with this, and I'm going to put my dollars where my mouth is here.
And then as far as sorry, what was your, go back to the question, Rob? Have I taken? Was it social media?
Yeah,
taking a tip from social media. Well, I think back to, I don't know,
just skincare tips. That's all. That's all.
I got to dial in that morning routine,
that's right,
Rob.
That's right.
No, we had a friend of the show on, and he's a big time investment guy. He's got a big firm up in New York. And just we talked a lot about investing. I'm not going to say the specific company, but he had mentioned this company. It's a Latin American company, and he's just like, he was kind of joking, but also serious, and just kind of threw it out there. And I was just like, okay, fine. And so like later that day, I went and bought some because again, it's within that 5%. I mean, it's much, much smaller than 5%. It's just a way, if you're looking for a little bit of interest, a little bit of zest, a little bit of skin in the game, I think it can make following the markets a little bit more fun. But I keep that super limited.
We call it the pressure release valve. Right?
Yeah, the 5% or less.
With like a little bit of your money, having a little bit of fun,
I'm fine with that.
Taking a few riders can be fun as long as you're doing the main thing, the right stuff with the majority.
So literally, my wife and I had a conversation yesterday, and we were talking about the Harry Potter series reboot, and I saw that. I was just like, oh my gosh, they're going to span each season. Each book is going to be a whole season, and they're expecting this to last a decade. I'm like, they're going to crush. So
invest in Max.
So yeah, HBO, which you can't. And so who owns HBO? It's Warner Brothers. And so I'm kind of like, oh, all right, maybe I'll just buy like one stock, and that's my Harry Potter series. I mean, it's like fantasy football or baseball, right? Like you got a little, like when you're following a certain player, you're a little more interested in the games. Should it completely change how you are investing with the overwhelming amount of your investable dollars? Absolutely not. And like I would say, I could, on one hand, no, probably on two hands, I can probably list out all the different individual companies that I own, but that's it. And I only do it right when I think about it, because investing is so incredibly easy, but it's a very, 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 very small amount of my overall portfolio.
Right on. Okay, so well, let's see what the audience thinks the answer is. You guys have cast your votes here. Let's pop the results here on screen here. So it looks like the majority, or the largest,
podcasts.
I guess, is people think podcasts and social media. And then we've got a tie between friends and family and print and online media stories. Guys, it's actually still tried and true print and online media. That's the actual answer,
wow.
At least according to this survey. So over half of the DIY investors considered this investment source when they were making an investment decision. Here's a really interesting thing, though. Yes, friends and family was the next most popular one in the survey, but social media, podcasts, it was like less than 1% of the respondents. So I don't know if maybe Canadians are different. Maybe Canadians
we hold no sway. That's amazing.
Classic American opinion, over like thinking too much of ourselves.
Okay, well, anyway, fun stuff. I have another segment here for you guys before we get to our Q&A, and this one's called Hits and Misses. So we're going to talk about, we've talked about some of the funniest mistakes that you guys have heard, but let's turn the tables a little bit on you here. What are your funniest investing mistakes? So, Joel, I'm going to start with you this time. What is the funniest investing mistake that you've made, and what did you learn from it?
Okay, so I don't know how funny it is, but I don't know. I continue to beat myself up over this, and I do not know why. I was 21 years old, was trying to pay off my student loans. The interest rate on those student loans was 1.875%. And so instead of putting money into my Roth IRA, into my tax advantage retirement account, I paid off my student loans instead. And it was a couple grand, and I was so stoked to pay that off. Knowing what I know now, though, it feels like such a hollow victory to pay that off sooner, because the interest rate was so low. So not like super funny, but it's also kind of weird that I still think about that, and I 20 years later, and I'm like, that's the one that got away from me.
Yeah, I get that. It's interesting. I mean, like, yeah, we're not funny guys. The stories that we talked through earlier aren't necessarily funny, because like in the moment it sucks, and but like you give it some time, and over time we can look back on it and kind of we can laugh at ourselves. That's the difference. When you're in it, it totally sucks. But then, yeah, hopefully we were able to mature a little bit, laugh at ourselves. And I think that's the biggest thing, too, that we're trying to get at here, is the fact that Man, we should probably take ourselves less seriously. But as far as me, so I think I chose friends and family as far as the investing advice, because that is what I did when I was first investing. I had heard from a friend who had done some research, and he's like, "Oh yeah, you've heard about the Roth IRA, right?" I was like, "Yeah, I think I've heard a little bit about that." At that point in life, and I was 21, 22 years old, and he had done a bunch of research, and he had been invested with this with a company, and they had one of those rock star hedge fund managers. But with that comes a very steep expense ratio. But they're like, you know what? It's kind of expensive, but his track record, he had been beating the S&P 500. I didn't know all this at the time. Since then, I've been like, why did I actually even ever do that? And it was a convincing argument. He had outperformed the S&P 500 for like, I don't know, 15, maybe 20 years. But of course, the year I invested is when
things fell apart.
Is when things fell apart in 2005, and that was the first year that he did not outperform the S&P 500. And I'm sitting there paying out the nose in fees, and yeah. So that's my. In retrospect, I can look back and lesson learned. And honestly, better for me to learn back then with like $4,000 than today with $40,000. So I don't know. I'm all about making those mistakes with fewer zeros at the end of it.
It goes to show those past results are not indicative of future returns either, right?
That's right. That's right. Yeah. Well, you know what I would say. You know, your two big blunders there, if you will. All things considered, not too bad, guys. I think you guys pat yourself on the back here. Not too bad. You know, just speaking about the fund manager performance, it always blows my mind when you look at the S&P does like the SPIVA. It's called SPIVA reports. It looks at like what percentage of equity funds in each market outperformed just the broader index. And over 1 year, maybe 3 years, yeah, it's doable. It's closer. But when you look at the longer term, it's tough to beat Mr. Market, right?
It's no doubt.
So let's give you guys some redemption here. And Joel, we'll start with you. Biggest investing success rather that you've had, and what did you learn from that?
So biggest investing success was starting investing in real estate, and specifically like buying a duplex to live in. I lived in one half, rented out the other half to a friend, and it's amazing. I think house hacking is kind of the common terminology that people give to that now, and that set me up for so much success, because when you are not only putting money into something that is an investment that's going to grow in value, but you're simultaneously reducing the costs of one of the biggest line items of your budget, which is housing. That's a double win that with compounding, it feels like it's even more than that. So I think investing in real estate and doing house hacking early on, and then holding on to those properties over time, that's probably been the biggest financial win for me. It's the slow and steady market investing. Awesome. I recommend it. And not everyone wants to invest in real estate, but for me, that was the biggest investing win.
Yeah. I did not think of that one. And so I can't use it now that you said it, Joel. But so, I mean, kind of going back to the beginning, when we started the podcast, it was because we had been for years talking about real estate, and kind of going back to the movie reference, Moneyball. Like, I feel like when we were having those discussions, we were looking at each other and saying, why aren't we buying as many homes as we can possibly afford? Which is not like we don't own like dozens and dozens of homes, but we're like, okay, instead of buying the next house for my wife and I, maybe instead we're going to buy an investment property. Maybe we can scrape together enough to put 20% down. Yeah. And it was looking at the facts on the ground and realizing, are we crazy? Or does this not look like a fantastic deal? But because of the Great Recession and how so many people got burned, folks were hesitant to get back into the market. But I will second that. And going back to the market, though, I would say, and this is like more just luck and timing, but I dumped a bunch of money into the market back during COVID, during lockdowns. And in March, it's just like everything is on sale. So in a similar way, like, why am I not going to try to buy as much as that's humanly possible, even if that means dipping into our emergency fund a little bit? Oh, I actually hear there's stimmy checks on the way, so it sounds like we'll have some more cash. Like, how comfortable, and this is my wife and I having a conversation, but how comfortable are we like basically we backed up the truck. I think Morgan Housel, friend of the show, or Ben Carlson, one of those two said, hey, when the market's like this on sale, that's when you back up the truck and you dump as much into the market as you can. And that's something that we did. And, again, it's
the
more
Warren Buffett way of thinking too.
Yeah,
right?
yeah. I think the lesson learned there is just to not freak out when everybody else is freaking out about the market. To be a little more cautious when everyone seems a little more gung-ho, when everyone's fearful, perhaps looking for opportunity.
Yeah, famous market idiom that definitely holds true. I think a lot of people get caught up in the fact that, hey, my portfolio is declining in value now, but if you're a long-term investor, really all you care about is, do you think it's going to be worth more 20, 30 years from now, whatever it may be, right? So why not get things on sale if you can? So guys, fantastic conversation. We're going to have to leave the conversation portion there, but let's get to some Q&A from our viewers here. You ready to hear what people want to know more about?
Sure. Yeah, for sure.
All right, let's dig in there. And by the way, for those of you watching, if you've enjoyed the show so far, make sure you check us out, TD Direct Investing, on social media here. We're on Instagram, we're on YouTube as well. And if you're joining us in our broadcast platform here, there are links to the How to Money podcast there in the resources section that you can check out. Really great show. I think you're going to get a lot of value out of it, and it's just a great listen too. And maybe you can crack open a beer yourself too while you listen, right? Why not? Okay, let's get to our questions here. We got one coming in from Aubrey, and Aubrey is asking, while analyzing a potential stock, how much influence do you place on the PE ratio, or the price to earnings ratio?
That's a really good question. I mean, so we don't do much investing in individual stocks. We think mostly about investing in the overall stock market. But I think when you look into PE ratio of the overall market right now, too, people would say, oh, my goodness, the market is overvalued. So if you're talking about even just investing in the overall stock market, when it appears to be overvalued, we would say, well, people have been saying that now in this bull market for so many years. And if you stopped investing because you felt like you were near the market top, or you felt like the market was overvalued, and let's say you did that in 2021 because there was a lot of ink spilled about overvaluations back then too, you would have missed out on a significant market run up. And so I guess as long as I'm just dollar cost averaging, sticking money in like clockwork, I think very little about what's happening with the stock market and where valuations are right now, especially when I'm in the wealth building phase of my life and have a much longer time horizon to invest. I think about it a little differently if I'm, 68 years old and I'm nearing retirement. But when we're talking about having a long runway, I just don't think it's something that needs to enter into the equation too much. Yeah.
Okay, so we have another question here coming in from you, and kind of along similar lines here, wondering if there's going to be a big market correction in the next year or two that you see coming, and like, what are you guys doing, to deal with that?
Yeah, I mean, we aren't in the business of making predictions, and again, if there is a correction, okay, great, more opportunity to buy on sale, and so, yeah. I think it's a fool's errand to try and time the market, to look at PE ratios, to determine is now the time, as opposed to just buying without thinking about it. Like you said, the more you mess with that bar of soap, the smaller it gets, the more you mess with it. If the market's at all-time highs and I had a bunch of, dry powder, like if I had a bunch of cash on hand, like would I deploy all of it right then and there? I don't know. Maybe I wouldn't do that. But I would certainly at least stick to my original investing plan, regardless of where the market's at, investing a certain amount every single year without fail.
It's also important to note that sometimes, not always, but sometimes significant market corrections come with greater overall economic turmoil. And if that's the case, you also want to protect your personal financial situation, right? Part of it is about maybe being a little advantageous and investing more when the market is on sale, but not if you don't have enough cash on hand in that emergency fund, like I talked about earlier, to protect you from potential downside of job loss, right? And if you don't have then the liquid savings and you're tapping your investments at an inopportune time when the market's down, that's like the worst possible scenario. So you have to save like a pessimist and invest like an optimist, like our friend Morgan Housel says. And if you save like a pessimist, then you can take advantage of those situations when they arise. But if you don't have enough savings on hand and you don't have enough liquidity, if your own personal financial situation takes kind of a dive, then you can't take advantage of those market downturns.
Maybe just a follow-up question, if I could. What you're kind of describing here, when the market is down, you're essentially talking about buy the dip, right? Is what it's commonly referred to as. Do you like to set aside money waiting for that dip to happen, or is it kind of just like when it happens, I've just been continuing to do my regular investing, and if I can scrounge up some extra dollars, to pop in there, I will?
So kind of going back to what I was saying before, always like to prepare for the upcoming year, right? And so think of it like a bill. So rather than getting hit with a bill on January and being like, oh, okay, I got to save up the money for this year and then pay this bill off sometime this year. I like to save up for the year prior to that. So if I know the bill's coming in January, the previous year, I'm setting aside money in my savings, building up that cash reserve. That way, when January hits, boom, all that money is going into the market. That being said, going like buying the dip, I dipped into my emergency fund. I dipped into reserves to be able to take advantage of an opportunity. Did we deplete everything? No, because that would have put us in too precarious of a situation. There was, in fact, a pandemic going on, and we didn't know what we know now. If I did, of course, I would have. let's put it all in. But not knowing the future, of course, that's not something that I would recommend. So.
I think buying the dip has become a popular strategy. But I think what you have to question is, how big of a dip is enough? How long did you wait when the market was going up and would you have been better sticking the money in before you formulated that strategy? And I think for most people, avoiding the sort of buying the dip mentality and instead front loading, investing at the very beginning of the year, or dollar cost averaging are much better ways of thinking about it. Because sometimes you wait for the dip and the dip doesn't come for a heck of a long time, and your cash is just sitting there in a high yield savings account, barely outpacing inflation, and you missed out on a 35-40% run up in the market while you were waiting for a dip to happen. Then maybe it dips by 10%. You still would have been better off putting that money in a year and a half ago.
And I think it comes down to like, what's your time frame? Because like when someone says, I feel like, and often if you're on forums and whatnot, when folks are talking about buying the dip, they're looking at it from like day to day, hour by hour, even minute by minute with some of the different crypto and meme coins and different things like that. But I don't think you should be looking for the dip. But as you are looking at let's say a year at a time and there's a significant sell-off, okay, there's an opportunity. I think being able to take advantage of an opportunity before you is a lot different than staying glued to the markets and watching the tickers and watching the charts, because, oh man, right now, that's when I think you start getting, it starts getting real messy. You start eating into how much money you've got set aside for investing. You start making, rash buys and sells, and so keeping an eye to
making more emotional choices than rational choices.
It feels more emotional, feels less data driven, as opposed to being like, there's a 23%, okay, a couple weeks later, 25 to 30% drawdown on the market. That's a dip, and there's certainly opportunity there. And so I think if you zoom out enough, that's what you're looking for. But the day-to-day gyrations aren't something that we're interested in.
Mm-hmm. Okay, we got time for one more from Anthea, and she's wondering, again, a little bit along similar lines here, but she's curious that, if you're expecting that there's going to be volatility in the U.S. economy under the Trump administration, what do you think about the idea of basically reallocating, your geographic investments, maybe easing up on the U.S., leaning more towards something like Canadian or European or whatever the market may be? What do you think about reconfiguring things in that sense, trying to time the market on like a macro scale, if you will?
Well, even going back to the PE ratio discussion, when you look at kind of where U.S. stocks are compared to, let's say, European stocks or the world, kind of where things stand from a world stock market comparison, U.S. stocks are much more overvalued, and they have had a much better last decade than the rest of the stock market worldwide. And so this tends to happen, right, in the stock market, like where Europe will outpace the United States, and then vice versa for an extended period of time. Is that era of U.S. dominance coming to an end? That's a really hard thing to know. And so much does depend on personality and policy. And so I think I would not change my investing stance based on what's happening right here, right now, the person in charge right here, right now, a couple of policy ideas that have been floated in recent times. I would stand back and say, what does a good portfolio construction look like for me? What am I able to to endure, and what makes sense to me from a diversification perspective. And if something like a target date fund, where it does have, you know, U.S. stock exposure, Canadian stock exposure, it's got worldwide stock exposure, you've got bond exposure, if that makes the most sense for you, that's another like set it and forget it, one fund sort of approach. And so, yeah, I think that can be a wise choice. I just don't want people to kind of stick their tongue, you know, lick their tongue and hold their finger to the air and say, well, where are the winds blowing? Let me try to change my portfolio now, kind of based on reading the tea leaves.
Yeah, chasing the returns can be really difficult to do. Sometimes it's the moves that you don't make that end up paying off the most. I always like to think about it like that. But yeah. Anyway, fantastic. Thanks for fielding the questions from our audience here, guys. Fantastic conversation. Really enjoyed it. Any parting thoughts you have for our audience before we let you go?
Ooh, parting thoughts, Joel. What one thing do you want everyone to remember?
I want people to remember that money is a tool to help you enjoy your life, and investing is not this pursuit of getting even Warren Buffett wealthy. I have no desire for that, but it is this desire to grow wealth so you can live the life of your dreams, so you can be more generous, so that you can spread joy. Like money, I think some people have a hang up with it from even maybe an early religious perspective or something like that. Like, ooh, like having money is actually gonna do something to my soul.
It's bad. It's an evil thing.
Yeah, and I think like money can be fun. Growing money can be fun, and then it can allow you to be more generous with the people you love and with your community too.
Yeah. And I'll piggyback off of that, which is that if you are watching this video, there's a good chance that you're informed, you are very interested in growing your wealth, and I think the biggest challenge for folks like us, and we're with you, but I think the biggest challenge for folks like us is sort of like what you're saying, is just to keep it in perspective. And making sure that it is allowing you to achieve not your financial goals, but like your overall life goals, and to think bigger picture as opposed to only focusing on this financial, you know, it's the financial facet of the gemstone that is your life. It's an important one, but if you're only looking at it through that facet, you're kind of missing out on the big overall gem.
It's a nice like philosophical note to end things on here, guys. I really appreciate the conversation. For those in our audience, I hope you enjoyed it as well. Thank you for tuning in. If you like what you heard, you want to check out the show, we do this every single week, so you can check out in our broadcast platform here the upcoming events here. If there's something that catches your eye, just click on the link and you can register for it right there. Like I said, check out the resources section here. We got related episodes to the topic that we had today, as well as all the links to Matt and Joel's How to Money podcast and all their socials and stuff like that. Check them out, and if there's something that is in the resources section there that you want to check out further, again, click the link. We appreciate you guys all joining in here. We're going to leave it here for today, but thanks so much for tuning in, everybody. Keep learning and have a good rest of the day. See ya.
Have more questions? Check out the links to the right and in the description below.